first of all, I want to say this presentation is based on very exploratory research, so it's a long way to paper. So I hope not to spoil the extremely high standard of presentation that we have in the morning before lunch. And this is based on work that I have conducted with my colleague Chris Roberts. So the question we are addressing is how has International Financial Services Centre in Ireland weathered the financial storm, the global financial crisis. Also, a part of the question is how able the IFSC is to weather the next installments of the financial storm, because all signs are there that the storm isn't over yet. So the first question is, what do we know about financial centres? And a natural place to go for some knowledge about financial centres would be to use financial economics. But you can spend whatever amount of time you want on financial economic literature, you will find nothing about financial centres. You will learn nothing. It's just another example how detached financial economics can get from the real world. But I know we have people doing PhDs in financial economics here in the room, working on topics like the development of the asset price bubbles, and this will definitely contribute to bringing financial economics back down to earth. Now, fortunately though, we have a lot of research in geography and in other social sciences on financial centres. And from an economic geography perspective, there are two conceptualizations of financial centres. Not surprisingly, they are seen as clusters or nodes in networks of financial activities and financial markets. So the cluster approach focuses on internal relations and agglomeration economies within financial centres. Network approach focuses on external relations, on connectivity and complementarities between different financial centres. There's also a lot of literature in social cultural geography and in sociology and anthropology on the social, cultural and political factors without which we cannot understand development of financial centres. It was said just before lunch, you cannot go into China and do economic geography without doing political economy. Well, the same would apply very much to finance, a very political, social and cultural field. After all, finance is based on trust and social relations. And the general story from historical literature on financial centre development is that there is a huge degree of inertia in it. It takes very long time for financial centres to develop. It takes long time for them to decline as well. And this inertia is probably greater than it is in other parts of services sector or in manufacturing. But there are major gaps in literature on financial centres. One of them is on secondary financial centres, just as there is a gap in literature on secondary high-tech centres that we had a presentation of this morning. Most of the literature on financial centres, again, is kind of just researches the optimistic, the positive side of things, the development of financial centres, but there is much less on the decline of financial centres, and particularly little literature on the impact of financial crises on financial centres. And for these reasons, IFSC makes a very interesting and attractive case study. First, it is the secondary financial centre still. Second, it is just celebrating this year its 25th anniversary. A good reason to do research on it. But most importantly, we would expect big things to have happened to IFSC because of this double whammy. Not only the impact of the global financial crisis, but also the domestic Irish financial crisis. So we're dealing with the impact of financial crises here. So some of the background to the IFSC was already presented in the morning by Provincias. So just to repeat the basics, IFSC started in 1987, very slowly. Well, 87 was a stock market crash, so the conditions were not that favorable, but then it took off in the 90s. The basis for its development was low tax, was 10% the corporate income tax offered to companies establishing themselves within the limits of the IFSC, so the old Dublin Docklands. And around 10 years ago, this rate has been partly under the pressure of the EU increased to 12.5%, and it's the same as for any other companies. Okay, so it's not an offshore center in a strict sense of this word anymore. It's a low tax but not a secrecy jurisdiction. It's all subject to European regulation. Actually embracing European regulation, especially regulation that has introduced in different parts of the financial sector a common European market, has been the game that IFSC has played. Yeah? First out of the tracks to adopt all kinds of European directives integrating European financial markets. So it really, IFSC really succeeded capitalizing on the single European market in financial services, and also at the same time Anglo-Saxon connections. Yeah? And here very instrumental where the Irish communities in the financial sector in the US, in Boston, New York, Chicago, and also in the city of London. And it's a financial center which specializes in funds administration, but there is a significant degree of diversification since in insurance, in banking, treasury services, and other parts of the financial sector. So, let me start to look at the impact of the crisis. Okay, so if we're very lazy, the first thing we could do, we would look at ready-made rankings of competitiveness of financial centers. Yeah? Speaking about rankings of competitiveness that we had a presentation on in the morning, for financial centers we can use the most influential global financial center index. Okay? Not even 2 years ago, yet in March 2009, Dublin ranked 10th, okay, in the ranking, ahead of Toronto, ahead of Tokyo as a competitive financial center. In the latest edition, in September 2011, Dublin is only 43rd. Okay, so this is a fall of 33 places, and probably the biggest in the history of the index. The biggest in the history of this index. And importantly, Dublin 14 places behind Luxembourg, the major competitor of the IFSC, because it's also a low-tax jurisdiction which built its fortune on dedication to European financial integration and specializes in fund administration. And now Dublin, we see Dublin behind Helsinki, behind Oslo, behind Qatar. Drama. A very dramatic picture. But I would be very skeptical about this for the reasons we have to be skeptical about any rankings like that. First of all, the ranking is designed intentionally to produce drama. Okay? It's based to a large extent, the places in the ranking, on the market sentiment. Yeah? What financial practitioners actually think about competitiveness and how it's changing on different financial centers. So it's very, very sensitive to market conditions. And if you like, that's on purpose because in every edition of the index you have changes, and this creates publicity. Okay, without blaming, the people who design the index for that. Yeah, it's just the way it measures. It can over-dramatize shifts in the competitive landscape, of financial centers. So let's not panic and look at some other figures. And obviously, we also have to qualify this picture by saying that this is about Dublin as a financial center. This is not about IFSC. And IFSC is bigger than just Dublin. It includes companies that operate throughout Ireland. And it's at the same time smaller than the Dublin's financial sector because it's just about the export part of the Irish financial sector, yeah? So not the domestic financial sector, although it's a very difficult distinction to make and very blurry. So this is one of the problems actually with studying IFSC now. So let's look at a different measure, because really the story of the impact depends on what measure you choose. So let's look at profitability, and here as a proxy for profitability, look at corporate income tax revenues from IFSC firms. So we can see, well, here it's a decline from 2006 by nearly 40% in terms of CIT revenues from 1,100 to just about 600 million euros. So a 40% decrease. Okay, but obviously, falling profits do not necessarily imply falling levels of activity. Yeah? So if we look at measures of activity in the core sector of IFSC funds, okay, here actually pretty robust. Okay. The number of funds operating, and this graph shows just the domicile funds. There are also non-domicile funds for which the picture is quite similar actually. So the number of funds now is, in 2011, was almost as high as in 2008. And actually the value of assets under management of these funds is highest it has ever been. It's a similar picture for non-domicile funds. If you look at that insurance activity, well, it's even better if we take non-life insurance. Here the revenues in terms of premium collected in 2009 was already the highest it has been, and it hasn't declined since, though I don't have exact data. And in life insurance also, 2009 already showing signs of recovery from the dip in 2008. If you look at banking activity, when we look at assets, total assets, not such a bad picture, though worse than for insurance and much worse than for funds. Here in 2009 we have a quite significant decline in terms of the value of assets of foreign banks operating in IFSC. This is partly caused by deleveraging of banks internationally. They're basically slimming down their balance sheets, and there is less in the value of assets to be managed, to be registered abroad as well. So there are signs of deleveraging in international banking that affect the value of business conducted by IFSC firms. If you look at a different aspect of banking, and this is what at least has been considered, this high finance, securitization, so creating these special purpose vehicles, okay, which help financial firms to separate some assets and liabilities, can be abused to actually hide leverage and hide activities from the regulators of the institutions that create and use these special purpose vehicles. Now in Ireland this has been done through these the so-called Section 110 companies, and here we can see quite a dramatic decline in the new registration of these special purpose vehicles in Ireland. So maybe we saying goodbye to some forms of securitization, and maybe for the better, because actually it was securitization of mortgages and subprime mortgages that was a major cause of the global financial crisis. If we look finally at employment, which we can consider the most important measure, the most kind of down-to-earth measure, the picture is consistent with what we've seen happening to level of activity across different sectors. So in insurance we see actually no sign of a crisis. Okay? We see continued increase in employment. In banking industry, which partly serves the fund industry, here the distinctions between the categories are quite fuzzy. But in banking we've seen some decline in employment from about 11,000 to 10,000 between 2007 and 2010, but more than compensated for with the insurance industry increasing. And then the funds, the core of the activity, this has leveled off since 2007. So if you add it together, total employment in funds, banking and insurance, so just in pure financial services, because this doesn't include accountancy, this doesn't include law, this doesn't include other professional services involved in serving IFSC. So if we just add the pure financial services, we get the total employment of about 25,000 and a leveling off of employment since 2007, but not a decline in total employment. So what we're getting then is a picture of relative resilience, at least so far. So the question here is, what are the sources of resilience? And here I'm using my understanding of international financial markets and also interviews we have conducted in IFSC firms. I mean, the first obvious reason and major reason is that the foreign demand for these financial services has continued. One reason here is clear. It's the global financial crisis, at least. It was not. It's called a financial crisis, but it was a banking crisis primarily. Okay, not an insurance crisis. If anything, demand for insurance products is even bigger because the crisis highlighted insecurities in the global economy. It wasn't a major asset management crisis. The values of assets dipped in 2008, but have recovered in many markets. And mainly a banking crisis. And banking, giving loans, that's not what IFSC firms do. So the specialization here is in fund management, and it's partly through this specialization that the impact of the crisis has not been as dramatic. Another way to put it is that financial markets are often divided into primary markets where you give loans, where you issue securities, and secondary markets where you trade securities and financial products. Now, IFSC does neither. So what does it do? It does the often overlooked thing, which is maintaining and creating buckets in which you put different financial instruments. Okay? So these buckets are both legal and kind of financial and accounting abstractions or devices. Okay? And then you have to maintain them, you have to account for them, you have to keep track of them. So that's what IFSC does. Yeah? It's the maintenance of investment vehicles. Okay? And this hasn't been that affected by the crisis, at least yet. There's been also little contagion from domestic banks. Okay? Irish domestic banks had relatively little to do with IFSC, so the interaction wasn't strong enough for the domestic crisis to affect IFSC. Actually, ironically, the domestic banking crisis benefited IFSC firms through lower labor and real estate costs, yeah? Which almost all interviewers praised that, oh, that's great, now we can pay less, and we don't have such high turnovers. Yeah? In labor. Another reason, though this is contested, but my reading is the regulatory response in Ireland has not been very heavy-handed. There's been some centralization and transfer of power from the regulator to the central bank, as is fashionable around the world. In the UK, so central banks take over the regulation to make sure it's stronger, it's better. But it hasn't been an overreaction, I think, here, whatever the financial practitioners say. They always complain about regulation. This is what they do. Okay? They complained 5 years ago as well. Another very important thing is the government's commitment to what is still a very attractive, very low corporate income tax rate, especially in an environment where of austerity and governments considering higher taxation. So what's the future? Obviously, the government has a strategy planning to create more than 10,000 net new jobs within a 5-year period by 2060. Now, how? First, it is building on established strengths. For example, maintenance and fund administration for alternative investment funds. There is a new directive in Europe coming on this topic. Also developing synergies with the domestic industry and services. More firms in financial software production, more firms in aviation finance. Okay, so there's kind of more of what IFSC has been good at. There's also an issue of upgrading to mid-office and beyond. Yeah, this is this constant theme in the development of the IFSC. How do you move from the back office, from fund administration to actually fund management, deciding on buying and selling securities and marketing securities? This is going to be very, very difficult. And also move to new markets. Obviously, Asia. Everyone wants to manage their assets. And green finance. Green finance, the most kind of esoteric, at least in terms of this is presented obviously for marketing reasons, very important, but whether it's actually happening, it's difficult to judge. Now, is it realistic in general, this plan 10,000 new jobs? I think it's not realistic. We live in an environment where financial sector is contracting internationally. Actually, it's interesting because some people think, okay, that the worst of the global financial crisis that was started in America with the subprime crisis, this is over. But there is a significant delay between the crisis, when the crisis hits, and laying off people in financial services. Even in this, what is quite a predatory sector, laying people off is the last resort. Yeah, human capital is the main asset of the company. So it's interesting to see that the number of announced job cuts, financial job cuts, is for this year is the highest. Okay, much higher than 2011 or 2010. Now, since 2006, US financial sector lost more than 500,000 jobs. Okay, and in the UK, they expect 11,000 financial job losses just in the first quarter of this year. And Wall Street lost 2,000 jobs in December last year, just in 1 month. Okay, so it seems to be the competition between financial centers this year, but also over the next couple of years, may not even be a zero-sum game, maybe a negative-sum game. Okay. Now, unpredictable financial regulation. And here, one big thing on everyone's mind, financial transaction tax. Yeah. We may need it internationally, and for social reasons, obviously a huge scare here in Ireland, and probably for good reasons. The tax is supposed to punish short-term trading, buying and selling of financial instruments. But if this is punished, then there are fewer incentives, for example, to create and run hedge funds, which to a large extent now rely on high-frequency trading. Okay? Now, if there are fewer incentives to create them, there will be fewer jobs, to maintain existing or new funds. Okay? So lower demand for fund administration, especially for alternative investment funds or hedge funds. And obviously, the biggest problem for the IFSC is the biggest problem for all of us and the whole world economy, which is the Eurozone crisis. But the important thing here is that for IFSC, it's a kind of a, in Ireland maybe in general, it's a bit of a double whammy again. Because if things go wrong, if Eurozone falls apart, then European single financial market starts disintegrating, and this is what the fortune of IFSC was built on, was to serve as a platform for both EU and non-EU based firms to operate in the single European financial market, and the common currency was also instrumental to this development. So that's bad news. But what if we have good news? If the core European economies, with Germany in the lead, get their act together and move towards more fiscal integration to save euro? Well, good news, but in the long run it may be bad news, because fiscal integration and harmonization puts pressure towards common tax policy. And common tax policy obviously threatens the low tax regime in Ireland. So I'm afraid that although one result here is that IFSC has weathered the financial crises remarkably well, the dark clouds are still there and are gathering. Thank you.